Welcome to all our CFA members and guests. This is another version of our Macro Matters podcast. Of course, we are on April 4th, right after Liberation Day, or as some are calling it now, Obliteration Day. As always, I'm joined by my co-host, Tony Zhang. And today we have a special guest with us as well, another fellow CFA Society Chicago charter holder and member, Blaine Reed. So welcome to both of you guys today.
Hi, Rich. Hi, Blaine. It's so good to actually come back after the Liberation Day. Apparently, like a lot of market participants don't like that.
Yeah, they've
And
been liberated of their profits for the year, that's for
yeah,
sure.
they don't like that. But we definitely have a lot of to discuss, and
Yes.
definitely it will be a great pleasure to have a Blaine to join us.
Yeah. Thanks, guys. Thanks for having me, Rich. Thanks for having me, Tony. Happy to be here.
So those are listening to podcasts, we'll walk you through what we're looking at. But for those that are going to be watching this on YouTube, we have our Bloomberg screen up. And so of course, we want to just start by looking at you know, looking at the sea of red, if you will, that is characterizing the equity markets right now. And you can see as it's ticking here, we're now down around 12% in the S&P, closer to 18% in NASDAQ for the year. And even some parts of Europe have turned into the red after being up sharply this year. And so that's obviously the talk of the town. But I think one of the things I wanted to kind of maybe bring up, and because this kind of came up on one of our investment exchange forum podcasts earlier this week, and this is the 60/40 portfolio. And so, only until the last couple of days, we've taken a little bit of a dip, but even up until April 2nd, a 60/40 portfolio was up for the year because of the rally in the treasury market and rally in the bond market. And even with the sea of red today, this a 60/40 portfolio is down only I mean, it's down, don't get me wrong, it's negative, but it's down 4% this year. So we're really for a balanced, diversified portfolios. We're not, we're looking at an adjustment for sure. But we're not necessarily looking at you know, cataclysmic type of performance by any stretch. And in the markets that were overvalued, maybe this has the news, et cetera, that we've gotten in the last couple of days has maybe expedited some things that might have happened. But it was certainly a difficult situation. So just maybe 30,000 foot view. And since Blaine is our guest today, we'll start with Blaine perhaps. Just kind of maybe talk to our listeners about how, as institutional investors, you guys are trying to think about a world that is quite uncertain. That since we're talking about tariff levels we haven't seen in 100 years, clearly none of us have ever been through something like this. And so just think about how you guys are trying to approach the uncertainty and try to think about positioning.
Yeah, no, thanks, Rich. I think that's actually a really great point. I would say it's a couple different facets. One, as you just outlined, there's just a lot of uncertainty. And even this morning, getting some news about some calls with Vietnam and changes that could be coming there. So the playbook here is new for everyone. And I think as we're just thinking about a new administration, new policies, this, take away the volatility we're seeing, these things sometimes take time to work their way through the system to where markets can price around what the actual policies are. And I think the sooner that we can get to that point, whether or not these tariffs are here to stay or if they're negotiating numbers, the sooner that maybe us and markets can actually start to make some decisions, longer term about where we want to, put our assets and our cash. I think secondly, longer term, some of the things that I'm thinking about are just implications to growth and demand, and what these tariffs will have as companies maybe think about their investment strategies, the slowdown you could potentially see there as they try again to figure this out, and then just the consumer, what choices they're going to make going forward about their spend and what implications that might have just on, for instance, imports. So those are the types of things that I think that spending time on thinking about in our space. So
Yeah, I mean, you bring up a good point. We kind of talked. I know I talked to my students about this. When you look at just GDP being government spending plus consumer plus business plus exports minus imports. We know government spending is going lower. Maybe we don't know how much. We know exports by minus imports is going to be a drag on GDP. And now the question is how much consumers will change their preferences and how much businesses will forestall CapEx given the uncertainty to try to get a magnitude on that potential slowdown in GDP. So I think that's a fair point.
Correct. Yeah. Yeah.
Tony, what are you thinking? I know before we were talking about here, you've got your blue buy tickets out today, so you're obviously feeling a little bit more optimistic. How are you trying to think about the world?
Well, as what Blaine actually just signified, apparently, if we actually look at the current markets, like we have to think about both macro and micro level perspective. Okay, the macro level because we have a new administration and simultaneously we have a new either both physical and also the foreign government policies, trade policy here. Apparently, like from macro level, there are actually a lot of it going on. Okay, then things can continue to change. For instance, like why actually President Trump actually tried to impose such kind of a reciprocal tariffs against other country or other major like a trading partner, and we have been discussing like for quite some times. And if for the audience of our Macro Matters like podcast, if you recall, I mean the main purpose apparent here is trying to bring the manufacture back into the United States. That's certainly okay. For whatever the things that need to be done, this is something that need to be done. And the second major factor for that will be like for the interest payment on the national debt, which is actually $36 trillion, given the current high interest rate environment, 4.5%. It's like roughly about, you can imagine one third of the GDP, right? Actually will be used to pay out for interest payment. And it isn't unsustainable for the whole economy to continue to grow under the current situation. So there have been a lot of discussion over the macro policy, whether this will be right or whether to be wrong to have such kind of a reciprocal tariff. That we can actually discuss further into that. Now, but from the micro level perspective, has been a lot of going on since Liberation Day. Since market went down yesterday close to 4%. I mean, just right after the announcement. So market actually hit the circuit break right after the hour. So and was actually being halted for 50 minutes and resumed. But yesterday was roughly about 4%, and today it's like close to before we having this macro matter. Still, like Nasdaq went down close to 5%, but VIX, Rich, if it is something that we use something that you like to use a lot, if we can actually bring up the VIX.
Yep, right here. Got it for you. This is the front month VIX future, which is of course the one that we can trade. We can't trade the VIX index, but
yes, yeah, we can.
we see the futures or the VIX futures. The front month is up to a 30.
Yes, yes, exactly. So we actually look at this chart. If we just maybe put the VIX index over the past maybe 10 years, like when the average like a VIX number reading is roughly about 19. And early this morning, yesterday we reached about something like 30, and early this morning it reached about something like a 45 or something. Okay, now typically when VIX is or reach something above 2 standard deviation, which is 35, we are going to see a lot of discussion over the market, and simultaneously the panic, especially the panic over the market, then will actually cause attention from the Federal Reserve, from the current administration to really think over. Right now, today is a Friday, so I think Chairman Powell just reiterated that's like he likes to actually take a deep thinking before taking further action. But historically, statistically telling us when the market actually, the VIX went above 35, literally speaking, it just indicated close to the bottom of the market, at least within a year. Okay. For instance, what we can actually take a look at what had happened in the past maybe 5 years when actually the VIX index was above the 35. The closest occasion will be the August 5th, 2024. That was last year. And we know that last year, eventually when S&P rallied pretty much like a positive domain, double digit gain. The one before that was in year 2022, and apparently, like Maki also deliver very nicely positive like a return since that. I think the October 11th almost run up roughly about 7%. So here we actually turn out to be from the microstructure level when the VIX, yeah, here it showed a 40, which actually is above the two standard deviation 35. Now, this indicates a lot of retail investor, maybe some of the institutional investor panic in this level. So,
I would
yeah.
caution though. I mean, as a short-term bounce level, I think there's an argument to be made for that. But I think the counterpoint is if we look at 2007, it hit those levels and maybe the market bounced, but that was potentially a precursor to much, much worse things in 2008. I'm not suggesting this is going to be 2008 financial crisis. I don't mean to, but I'm just saying that there's nothing that says that a VIX level of 40 has to be an all-time low in the stock market, and we're going to go into a raging bull market after this. So I think we want to be careful about that because I think I would argue too that a couple things. One is that implied volatility is an input to the capital allocation strategies for a lot of different firms, including risk parity that uses volatility targeting, and including the value at risk type of capital allocation models we see in most of the hedge fund pods. And so as volatility is going up, hedge fund pods are reducing risk just systematically. They have to do that, whether they're discretionary or not. And in longer term asset allocators that use risk parity and have volatility targeting because they have some element of leverage to that are also reducing their risk. And those are people that are not necessarily taking a view on what's going to happen with growth or not. They're just reducing risk management into an uncertain world. And so maybe there's an element of capitulation. I think that's a fair point, Tony. But I think, we can look at, when you talk about Chairman Powell, we now have 4 rate cuts priced in for 2025. And if we go back even a week or so ago, we only had 2. So the market's clearly priced in 2 more rate cuts because of the uncertainty and the potential risk to growth that Blake was referencing before. But I don't know. I stand there and say to myself that one, you're not going to see anything from a fiscal stimulus standpoint like we did around COVID because it's pretty clear the direction of fiscal at this point, right? This is the U.S. fiscal policy making a very active decision to do this, not to support this. And so I think that's one thing. And then the other thing is kind of what I'd point out is kind of when we talk about growth, the market is still expecting 10% earnings growth this year. And then so when we talk about this is all happening I haven't even talked about valuation, but just thinking about, looking at a PE of 20, assuming 20 or assuming 10% earnings growth, you know, we're getting bad news on a market that is still, by historical standards, pretty fully valued, if not overvalued. And so I think that's where I see some risk. But I don't know, Blaine, what do you think about what we're talking about?
Yeah, so a couple of things. One, with this chart that you have up in front of us, this is interesting. I mean, I was going to ask kind of what thoughts were about where that should be. I mean, historically, I think what 16, 17 kind of PE on the S&P 500
Correct.
is
Yes.
kind of about where we've been. And if you're looking at something still around 20, it would imply I'm not
Well,
in the
this is
business of
yeah,
making
it's true.
predictions,
This
but
is what I'm looking at it like if
yeah,
now we could argue that the earnings yield of the S&P should be closer to the Moody's BAA corporate bond rate, which is historically where it's kind of been, which is around 6%, which is about a 16 times PE to your point. And
yeah,
so I think it's been even below Treasury yields. Now will that stay around 6%? I mean, yields of spreads have widened even though treasuries have come lower, but a 6%, that's kind of where corporate bonds have been the last couple of years, and that's
Yeah.
you could argue 16 times is where we're going for sure.
Yeah. So, along with that, and then, just a couple points you were making just a few seconds ago about growth, other interesting anecdotes that I've seen, at least this morning, both Goldman and JP Morgan upping their percentage of recession risk. I think JP Morgan's now at 60%, and Goldman is, I think, somewhere around 35%. And the way he was explaining that this morning was that was kind of their percent risk going into COVID. So to him, that's a pretty big movement for them to get to that level. So I think you have all of that going into, some of we mentioned the uncertainty, and just valuations for where things should be. It seems like to me we've got a little bit more, but I think this is what we're trying to figure out is just to everyone in their chair.
Yeah, so I mean, we look at earnings actual over the last 12 months have been about $245 in the S&P. And like I said, growth is expected to be 10%. If we just talk about 2022, which there wasn't a recession, even though a lot of people were calling for a recession, earnings fell about 14% in 2022. If we go back to COVID, earnings fell more like 35% in a very brief period of time. If we go back to the financial crisis, they fell 65%. So I think even if you expect earnings staying flat, let's just say, which is down 10% from where they are, and you put a 16 times PE, you're looking at 4,000 in the SPX, give or take, roughly speaking. So to your point, Tony, maybe two SDs in the VIX is a short-term buying opportunity. I think the point, though, that counterpoint I would make is on that bounce, I would be selling into it. I would be buying and holding.
Well, yes, yeah, Rich, definitely for some technical trading, I think this is definitely something that should be kept in mind. I don't actually just trying to argue that from macro level that we actually have reached out to that like a bottom to really for the market. From two standpoint, number one is whether the goals for the current administration, like President Trump, had been achieved. This is something we have to actually wait and see. From I think all of the people would agree it's actually quite difficult to bring the manufacturing back into the United States. Like President Trump, I think he make a very clear point. Just I think the day before yesterday, that the current semiconductor, the share of the whole U.S. company over the globally has actually went down like a very, very low compared to like pretty much close to 100% of the market share owned by the U.S. semiconductor company like Intel and AMD and etc. Now, most of the like a foundry business are in Taiwan, right? TSMC, everyone knows that, and same as like Nvidia, or Nvidia and other company all have their like most advanced or sophisticated chips made by TSMC. So from that perspective, he cites the national security as one of the concern that he say for the U.S. like to continue to grow and to be the leading position in the U.S. Well, from that perspective, like the goal has it would actually take a year to achieve. It's not a short term like goal. It's not a short term that should be reflected by the market. From our understanding, it's like why do we actually have the most of the industrialization or the manufacturing job have been actually shifted overseas. It is simply because we have a so high labor cost here in the U.S. Like many states have imposed like the minimum wage, hourly minimum wage for many type of jobs. Apparently, like a $15 here in Illinois. It's actually quite honest speaking, just compare the labor cost overseas, it's actually quite cheap over there. Now people can anticipate it. Maybe the new advanced technology like AI can actually enhance the productivity of the laborers in the United States. That's one of the arguments. A lot of economies continue to use it. The U.S. should focus on the higher margin type of higher end technology so that we can actually continue to stay at the top of the supply chain or the value chain, right? So this has been the argument and fundamental reason that why many of the manufacturing jobs have been shifted overseas. Now, with a lot of the fundamental reasons that the manufacturing job have been overseas, still actually remain very valid here even with the tariff that have been applied, like 46% to Vietnam or 34% on top of 20% that have been applied to China, even with the 54%. But whether those kind of manufacturing jobs actually will come back into the United States, that's still a huge question mark. As we all know that the gross profit margin for many of the manufacturing jobs, manufacturing type business is roughly about 3% or to 5%, right? And now given the current like a risk-free rate, interest rate here is 4.5%. So for the rational investors, so as what we discussed last time, rational investor would not actually invest into the manufacturing job, but rather just simply just deposit all of their cash into the bank account and take 4.5% instead of like investing into the manufacturing job. So here, the interest rate has to go down before that things could happen. I think that's what actually have been driving the fight between the current administration and also the Federal Reserve when that would happen. This is we do not know. Like the market has already priced in 4 times cut. This is at least more aggressive than we thought. Right? We have been talking about this. The market is always wrong, right? Market continues to be wrong in terms of like how dovish that the Federal Reserve could become. This is always wrong. But here we have high inflation simultaneously, and then we have if the interest rate was cut, then we would see that maybe the inflation will continue to go much higher, that leading to some most undesirable situation called stagflation. Right?
That's the difficulty though, right?
Yeah, that's difficult.
100 basis points of cuts, 100 basis points of cuts when you're talking about inflation that's already been persistently high, even before we have the impact of tariffs.
Oh,
That potentially has the issue, the catalyst of igniting inflation even to higher levels. And if you're a company and you're doing your net present value or your IRR analysis on building a factory, 100 basis points helps, but it's not going to change the decision because the uncertainty over the direction of the economy is
all
going to
right.
be way much more. One chart I have up that I think it's a bit of a misnomer. I don't know if it's a misnomer in the current administration or certainly among people I talk to. This is the data on the U.S. private construction manufacturing capex in the United States. And as we can see, since 2021, it's gone up over 200%. And over the last 10 years, it's been in a bull market. We have been reshoring in the United States, manufacturing for over a decade at this point. In fact, I would kind of point back to a podcast I did on peak globalization with Harry Moser from the Reshoring Initiative back in I think 2022, maybe it was, where he talked about the fact that if you look at the total cost of ownership, if you talk about not just the wages but also the transportation costs and things of that nature, um,
That
for a lot of products, it actually makes sense to just make things domestically at this point. And certainly when we start to include any sort of, if we have any sort of concern about one's carbon footprint, as a number of companies until this recent year had concerned about that. So I think that seems to, if that's the motivation, it seems to be like where the trend has already been shifting there. I don't know, Blaine, when we're just kind of thinking about things, we're kind of going back to this idea. I know you spend a lot of time in the credit markets, and credit has been fairly benign, and there's not, we haven't seen a lot of big issues, but ultimately, as I've always been told in my career in the hedge funds, credit investors are smarter than equity investors, and so we should be thinking about what credit is doing, not what equity is doing. So you're smarter than I am, Blaine. So tell me what I should be thinking about here.
That's a good statement before Blaine talk about that. I like that statement. It's like people keep talking about this, like the credit investors are actually smarter than the typical equity investor. Okay, Blaine, go
Yeah.
ahead.
Yeah, no, a couple points on that. I think if you you're looking at this day by day, right? And it's very hard to dig yourself out of that. But yesterday we did see some spread widening in, both, high yield and in loans. I wrote some notes down here this morning, just looking at some research. So high yields kind of yielding almost 8%. That was a 25 basis point movement yesterday, and kind of that's the high since August of 2024. So a pretty big move, yesterday. And when you look at loans, which is, my background, we were down about 5/8 of a point yesterday, kind of on performing credit in the 95.5. But year to date, we're down over 2 points. So we've had a decent move in credit. I will say that end of last year, there was a really large refinancing wave of corporations coming back and refinancing their debt. And so when you look at it for maybe the short to medium term, there are probably a lot of companies that don't, need to worry about their cap stack at the moment. And that's a positive that you can kind of see your way through. Maybe, as we talked about earlier, what is the policy going forward? And then I can address things, 18 months, 2 years down the line, as far as, my liabilities. Um, there's also cash on the sidelines. We saw some activity yesterday, midday, it sounds like, with some buyers stepping in, but this morning we're kind of widening out a little bit more. So I think a lot of it for levered companies and credit is going to depend, what we were talking about earlier, just that consumer spend. And, they have levered balance sheets, levered to a certain, call it EBITDA, kind of expectations, and if that gets impacted by the consumer pulling back, uh, then I think, you start to look at some of your lower rated credits as potentially having some issues and widening out more. And the movers that we've seen over the last couple of days, as far as price movements, were certainly, the lower rated credits into your story credits. Those names were moving around 2, 3, 4, 5 points. Was not uncommon to see on some of those names, which is a pretty big move, intraday on names like that. So
Yeah, I just
that's a
want to touch
quick
on
snapshot. Yeah.
something real fast. I mean, again, this is the credit spread I always look at, which is just
Mhm.
Moody's BAA less treasuries. I know you're referencing ones more that credit investors will be definitely using and maybe even benchmark to. But
Mhm.
we've definitely, as you can see here, this is a chart of the entire century, if you will, last 25 years. We've had a huge move here on the far right of the screen, from 140-ish levels up over 2%. Um, but in the grand scheme,
Yeah.
we're still well below the average credit spread, if you will. Now, absolute levels, that, to your point, had gone up quite a bit. We're still below on a credit spread basis, but so I think, and then I would probably guess is consistent with the fact that the credit defaults that we've seen in the economy wide so far have been pretty benign, and which is why people feel comfortable even at tighter spreads putting money to work. Is that fair?
Yeah, I would say that's fair. And I would also point out that some on this chart, some of those big movements there, certainly you're looking at a COVID movement, you're looking at the great financial crisis movement, and each of those have their own, unique attributes. But, at those peaks and during those runs there, I mean, you certainly had kind of access to credit, quote unquote, were questioned. And, I just kind of go back to the amount of money that was refinanced end of last year. Maybe companies don't feel like, that it's an access to credit issue right now
Yeah.
with the market. So you still have these big absolute moves, like you said, and then they're, certainly not to levels that we've seen in the past. But those really wide issues that you see there, the pointy ends, there were certainly some other things going on. So
Yes. I agree with what Blaine just saying. By looking at this chart, what Blaine just pointed out, apparently there was some kind of a unique circumstance like happening both great financial crisis and also in COVID time at this moment, even though we had a huge move over the past 2 to 3 days, but
Mhm.
it's still actually below the average, uh, which actually indicated that from the company level or corporate level, they do not see the huge like default risk compared to like the average in the past maybe 2 decades, right? This actually got some support from the unemployment data, which actually was released yesterday. So the initial claim of unemployment was actually still below the expectation that actually was that support the federal Chairman Powell's like he stand that actually Federal Reserve can actually has no rush to actually change the way of the changing the interest rate going forward for the rest of the year. They still have some kind of a time no rush at this moment. So this is economically we are actually in a very good shape by looking at the unemployment data. Apparently, unemployment is one of the two mandates from the central bank. This is something that they look at in addition to the inflation. Inflation is high, unemployment is still very low, right? It might tick up a little bit, but from the data, we actually don't see it economically so strong. Apparently, the financial market has some predictive power. It's like typically they respond maybe six in average, like 6 months ahead what's going to happen. We probably might see the charts might actually getting slightly worse once we actually come back for the next episode. But this is current situation, Rich Blaine. Yeah.
Yeah, no, and I think the Fed is in a bit of a maybe the recession is good if we have one is going to be good enough to bring inflation down. But to your point, with a dual mandate of price stability and full employment, the jobs numbers are not bad enough to justify lowering rates, and the inflation is still sticky enough, um, to keep rates where they are, and maybe not certainly not cut, not maybe not raise, but. I think when we saw the ISM data last week, we saw new orders collapsing, but we saw prices paid spiking, and that really suggests stagflation. And I go back to, I think it was a month ago, the St. Louis Fed president saying, when it was asked to should the Fed conduct policy when there's stagflation, and his response was the Fed should be looking at inflation expectations at the consumer level, because and basically saying, well, we'll let the consumer tell us if they're more worried about their job or if they're more worried about price levels. And if what I've got up now is the University of Michigan consumer expectations for inflation over the next year. Um, and the next release is next week, but over, last month it was already, like prices expected over the next year is 5%. Now this is can be a volatile stream, but right here that we know that inflation was a big issue in the election, and consumers seem to be telling us that inflation is still a big issue. So it presents a difficult situation for for the Fed for sure. But I just want to maybe tie in a little bit of what we talked about with earnings and talked about with credit, because as we know in markets, especially now that we are slightly more than 50% passive in equities, and we've got a big passive component that we have. Markets tend to be macro for 2 out of the 3 months of every quarter, but then 1 month out of the quarter we focus on earnings, right? We
Yeah.
focus on earnings and everything becomes idiosyncratic. Now maybe that's the case this time. We'll see. Banks are starting to report next week. And I think one of the biggest things that people will be focusing on with banks is going to be their outlook for consumer credit, right? Their outlook for what they want to be doing and what they think when you talk to JP Morgan or Bank of America, who have a very good look across small businesses and consumers, et cetera. Is this something where we think that, and I'll let you kind of lead, Blaine. I know equities may not be your purview, but just thinking about it, is this something where we could start to really refocus a little bit out of the macro onto the micro here, at least in for the next month or so. And is there good news for investors? Are there is Tony's buying justified because of what we're going to see, or is my selling justified based on what we see? What do you think?
I'm gonna be right down the middle and say time will tell, and we can reflect back. No, um, I think those are all good points about the consumer, and honestly, that is kind of where my head is at. It's just, what are their expectations? Um, how are those going to change? Maybe not what they are, but how are they going to change over the next, you know, 4, 6 weeks, 8 weeks, and how that might impact, earnings. Maybe not this quarter, but in the next quarter. And yeah, I just go back to the change in habits. I'm just really, really concerned and focused on that. And if we start to see those those habits change, how the Fed is going to interpret that. He was talking a little bit about what you were just saying a second ago about his dual mandate and the tension between the two, and he prescribed it as, um, we're going to look and see which one is furthest away from the marker that we want and how long it's going to take to get each one to their respective marker, and focus on the one that's furthest away and will take the longest. I'm paraphrasing. So I think everyone's kind of in a little bit of a wait and see mode. I guess that's a long way of saying that I think it's a little bit too early to tell, just how the consumer's going to react, and how the impacts of what's coming through the pipe are going to affect habits.
And thinking about equities, I've got the relative rotation graph up, kind of showing over the last month or so that clearly within the markets, even though the markets had been down a little bit, but there had been a very defensive shift in terms of how money has been flowing. It's been flowing in the consumer staples, utilities, healthcare, very defensive sectors, banks as well to an extent, and coming out of things like tech and discretionary. So there's definitely been a more defensive bent of investors, et cetera. Tony, does that give you comfort? Do you think that maybe institutional investors have been defensively positioned and are able to withstand some of the volatility that we've seen, and
Yeah,
maybe are able to
yeah,
think about deploying some cash?
yeah, Rich. The rotation graph actually show exactly right now. Most of the institution are position their position like in a recession mode. Apparently, like here during the recession, typically consumer staple, utility, and healthcare sector are the one that are outperforming the relative peers peers group over the market. Now here when we look at the position from the institution point of view, we actually might not know exactly how soon they are going to actually deploy and shift their positioning out from the current situation. Typically, the institution might actually take a slower step. But given what had happened in the past like a 2 to 3 day, and the VIX happened today, this is a very legitimate reason that we will be able to tell the market already priced in most of the situation. Well, whether there could be some worse situation that could coming out, for instance, the retaliation from the Europe, from China, and from the rest of the world will be much worse than what Secretary of Commerce had already caused asked for. This is no retaliation, right? That will be all. Well, this is very difficult to predict, and I when we actually look at how it's going to evolve, it's very, very difficult. One thing for sure is like no one can predict the future. No one can actually predict the market. From from investor point of view, it's actually better to do to actually manage their investment portfolio from more of a balanced view. It always worked in the past century, in the past like a 5 decades. Always we have, if we look at what market actually has done since like a great financial crisis. Every time, whenever we actually saw a market correction, we actually bounce off back. That's why Warren Buffett say like a never bet against the United States, right? I think Blaine Rich, we have seen this, we have witnessed this is like happening in the past 20, 30 years here. So we for this time being, like I do not see fundamentally like say, hey, the U.S. economy is so bad. Apparently, right now we do see some policy change over here with the current President Trump, like with some ambition to bring the industrialization back to the United States. This is like a short-term volatility. I think it's still will not actually change the course like that. The United States, it's still the most powerful economy in the world. It could be maybe take slightly longer, couple months, or even a year or 2 years that for the global the capital to maybe to rebalance or rethink whether this is something could change. But here, if we actually look globally, the U.S. is still the center of the technology innovation and economy here is still the strong. We still have the leading economy. Just like I from and investments have continued to actually come in from internationally as what President Trump has outlined, right? We actually we see many actually positive catalysts. Apparently, the short-term volatility is something that concerns to a lot of institutional and retail investors with legitimate reason, certainly for sure. But from long-term perspective here, I think we're still we might see some great opportunity for market to actually come out from this correction. This is just how I interpret it. Apparently, as I highly maybe I want to re-emphasize the impact of the macro factor, macro reasons over the American citizens will be imbalanced. That means the tariff impact would have a different impact over the people or the state in the Middle West versus the states on the coast area. We know the coast area has benefited significantly from the globalization process. And when we actually are going into the deglobalization process, that the coast area might take I think, stronger hit than the Midwest. This is what I would maybe continue to monitor the situation, whether this is something the Midwest economy will actually continue to change versus like the coast area, Rich and Blaine. This is how I.
Yeah, no,
Yeah,
that's a
yeah,
great point, and I think I would encourage listeners to also look at our shameless plug here, the Investment Exchange Forum podcast. I just posted one yesterday with Brian Westbury, who's one of the top economic forecasters, and you can go and listen to his thoughts on how he thinks tariffs and Doge and other parts of the policy may impact the economy in the next year or two. I think his points are certainly more supported than mine. And then the other one on when we talk about policy overall and what that means longer term. There's a geopolitics podcast I did with Riva Gujan that I think is also really good because she gives a global perspective of what's going on, not just the U.S. perspective, and I think that's important. You guys really want to quickly kind of point out the factors to watch chart that with Tony and I talk about a lot. We can see when Tony's mentioning people are pricing in recession type of activity. We certainly see low volatility stocks, large cap stocks, quality stocks are the ones that generally are been doing much better. We see stocks that are levered to growth or trade activity or momentum or earnings revisions have been the ones that have been struggling the most. And so clearly that defensive positioning. But I'm going to land on this one last point, and I'll leave it with Blaine because he's our guest here. Scott Bessent, the Treasury Secretary, hedge fund manager, one that I think a lot of people in the market respect his opinion, et cetera, has told us since the inauguration to not pay attention to the stock market, that if we wanted to judge President Trump's policies and the impact that they're having, we should watch the 10-year Treasury yield. And if the policies were successful, the Treasury yield would come lower. And that's what we should be looking at. And ever since the inauguration, where treasuries peaked at 4.8%, we're now down to 3.9-ish%, 3.92%. So the bond market may be saying that, hey, as much of as much as there's a sea of red in the equity markets, as much as there's lots of print being put out there suggesting that these are crazy policies, the bond market seems to be suggesting that $7 trillion of debt you have to roll over and $2 trillion of new debt is going to come at a much lower price, and so maybe that's not just a bad thing. Again, I'm not smart enough because I'm just an equity guy. Blaine, you're smart people. All you fixed income people tend to be smarter. What do you think the bond market's thinking? Is it that they really support these policies? Is that there's a fear of recession, maybe a little bit of both? How do you look at the 10-year Treasury yield, which is the yield that anchors basically every investment in the world?
Yeah, I got to really overlay it with concerns about growth. I think it gets back to, um, again, how long are these tariffs going to be in place? Is this something that's going to be in place for a while, and then the impacts to growth? I would tend to think that that's um, what's what's driving, there's so much that goes into the 10-year to begin with, but that's certainly overlaying some of the action you're seeing in the 10-year. And probably a little bit too, just we talk about rotations, and you led with the kind of 60-40 kind of portfolio earlier. If some people are just saying, I would rather ride this out in you know, 10-year government debt, and there's just been a bid for it here the last, short while. There's probably some technical aspects of that too, just about that sector rotation we were talking on earlier. So, but I would have to think that there's some concerns about growth going forward if this is the stay in place policy going forward. And I just actually, on that note, one thing that I'm also thinking about is just what is, you know, at the risk of not delving too deeply, but it took us a many decades to kind of get to the current tariff trade policies that we have now. And like everything else, it seems like it just moves faster every day. And is this just the environment we're going to be in from administration to administration to some extent going forward? And how do markets, back to some of Tony's points earlier about how do they make decisions to build a factory here in the US? That's a long-term commitment for an auto company, for instance. That's not a 6 or 18 month commitment. That's years. And by the time you get to that, you're going to have a new administration, and what's their tariff policy going to be? And how easily the stuff seems to change now, versus it seemed to be more sticky in decades past. So all that's probably weighing on the market, including the 10-year.
Yeah, for sure. And I think policies definitely do change. And I think policies, we talk about this grand notion of loving to have global free trade. The reality is we don't have free trade around the globe because there's domestic politics in every country that protects some industries and put these tariffs up for sure. And for those that like history, many would kind of point to the Reagan years as something where we radically shifted government and changed things for the better and led to a very strong bull market in the 80s and 90s, but they don't remember maybe that the first 18 months of the Reagan administration was a pretty nasty recession and a bear market in stocks. And so sometimes these adjustments, if they are due or not, that will leave that to the pundits that are smarter than us. But it can be painful in the short term, but potentially lead to long-term gain. And that's something that we should probably be looking at. I think since we've run up about 50 minutes here, we're kind of at time. So I'm going to leave it by thanking you, Blaine, for being our guest. We're welcome to have you back whenever you want, and thank you, Tony, for joining as always. Appreciate you guys both, and hopefully our listeners are a little smarter on the macro that matters that we've seen this week.
Yeah, thank you, Rich, and thank you, Blaine, to join us. Apparently, we are going to see a lot of the volatilities like going forward over the next couple of days when we actually start to see maybe some of the impact and how long the current tariff might actually be in place, as what Blaine suggested. This would have a huge impact over the sentiment of the institutional investors and also maybe the international investors, certain for sure. We will continue to monitor the market, and then hopefully this is like the current episode would give some kind of a idea, maybe some open up some mind or thinking for the audience of our macro matter. matters series.
Well, thanks, guys. Thanks for having me. I really enjoyed it, and great conversation. I know I feel smarter for it, so thank you.
And for the listeners,
Oh, it's smart.
for the listeners, we'll be back in a couple weeks where we'll probably have 2 more weeks worth of tariff changes, and we'll potentially have some earnings that we could kind of discuss and dissect and hear what the banks are telling us about the consumer and some of the uncertainty, try to sort through that. So for now, we're going to leave it to you. Thanks for joining.
Yeah, thank you so much.
Thanks.